For an ordinary working class person, debt is a four-letter, fear-inducing word. Why is it fear-inducing? Because most people who belong to the working class grow up hearing about debt as a burden. According to CNBC, the average American is indebted by $96,371 as of September 2022. These are made up from personal loans, mortgages, car loans, credit card debt, and student debt. Debt, however, has a wider meaning, which if understood properly can be used for earning money. To be more precise, if understood properly, debt can be used to generate wealth. So how can debt be used to make money? Well, in today's video, we will be explaining exactly that. But before we start, make sure you like this video and subscribe to our channel for more awesome content. Let's start off by looking at a simple example. How do banks make money? Let's suppose that John goes to the bank and deposits $10,000 into his bank account. John is going to earn, let's say, 2% interest on $10,000 per annum. This amounts to $200. The next day, James goes to the bank to ask for a loan for $5,000. The bank lends out $5,000 from John's account to James at the interest rate of 5%, which is $250. If the bank closes its door after these two clients, then, at the end of the day, the bank has a net interest income of $250 minus $200 equals $50, and $5,000 in reserves as well. This is a very simple example. In reality, banks get hundreds of thousands, even millions of customers, and this results in earnings that are easily in the billions. So, if banks can make money by lending out other people's money, then so can individuals like you and me. All it requires is some knowledge about financial management, financial instruments, and the financial market where one intends to do business. First, we need to understand the difference between good debt and bad debt. Good debt is any debt that allows you to achieve your financial goals. So if you take out a personal loan from a bank to consolidate your high-interest debts, and if this helps you pay off all of the debt without damaging your credit score, then this would be a good debt. Another example of a good debt is taking out a personal loan at, say, a 2% interest rate, and then investing it into stocks that pay a return of 4%. This means that your net return would be 4 minus 2 equals 2%. This is also an example of a good debt, because it can help you increase your savings. Bad debt is any type of debt that ends up damaging your credit score and increasing your level of financial stress. Bad debts make people miss their financial savings goals and end up creating more trouble than they're worth. Good debt is what we have to keep in mind for now. Now, the second thing to remember is your risk threshold. If you are going to generate wealth, then learning about the risk-to-reward relationship is extremely important. The risk-reward relationship is simple. Risk and reward are directly proportional to each other. The higher your risk is, the higher your reward will be. This is why junk bonds carry high rates of returns. They are junk bonds, which means they carry high risk of default, and therefore a high rate of return is offered in order to compensate the investors for the high risk. Low risk, on the other hand, carries a low reward. Look at treasury bonds, for instance. Treasury bonds are considered as zero-rated or very low-risk bonds, and for this reason, the rate of return on them is very low. Every investor needs to understand this relationship, because this is the foundation of investment decision-making. You must first analyze your own risk appetite. Are you a risk seeker or a risk-averse individual? The answer to this will depend on your financial stability and future financial goals. If you are stable and your goals are considerably high, then your risk appetite is likely going to be risk-seeking. This means that you are likely to invest in riskier investment options. If, however, you are not yet financially stable, then your risk appetite is likely to be risk-averse, which is a sensible thing to do. There's no point in taking risky decisions when you're not already financially stable. So far, we've learned 3 key financial investment topics: good debt versus bad debt, the risk-to-reward relationship, and how to determine your risk appetite. Keep these in mind as we discuss how to make money from debt. The first way of earning money from debt is through margin trading. Now, what is margin trading? This might sound complex, but let me explain. Margin trading simply means that you take out a loan to trade in the market and then use your profit to pay off the loan. So let's look at this in greater detail. Suppose you're a trader with $100,000 in your trading account. Now, you can use this money to trade, and it would be perfectly normal. If, however, you want to make money from debt, then what you will do as a trader is open a margin trading account. This will allow you to take a loan equal to or in proportion to the amount you already have in your trading account. So for instance, if you have $100,000 in your trading account, then your broker can lend you an additional $100,000 more, thus increasing your account balance to $200,000. If you were getting a 4% return on $100,000, then your return will double with $200,000. If you trade efficiently and make a profit, you can pay off the margin loan and walk away with a net profit. Now, margin trading sounds simple, but there are caveats. Firstly, it can be addictive. If you get the hang of trading right, you can become overconfident and put too much at stake. It's a bit like gambling, which is why you must know your limits. The best way to know your limits is to constantly remember your risk appetite and your financial goals. Secondly, margin trading requires knowledge of the market and the securities you will be dealing with. Many margin traders lost their fortune during the Great Depression because they could not see the recession coming and they were too leveraged. If margin trading is too extreme for you, then you can have a go at making money through personal loans. For this to work out properly, you must have a good to excellent credit score. Otherwise, the interest rate offered to you will be too high to get any decent return. If you can manage to get a low-rate personal loan, then simply use that money to invest into either a business or a profitable investment option. Profitable investment options can vary depending on how much you are willing to invest. Index funds, for example, are a low-risk investment option. They are basically mutual funds that track any index such as the S&P 500, FTSE, or Dow Jones. Since the index reflects the portfolio of the index it's tracking, the risk is low and returns closely reflect the return of the underlying index. Japanese stock markets, for instance, showed almost a 25% return in 2020. So by investing in an index fund that tracks the Nikkei, an investor could have earned a return around 20 to 25% in 2020 alone. Earning a 20% return based on a loan that has 4 to 5% interest is not bad at all. Your net return would have been around 15%, which is very high considering how markets were back in 2020. Another option, and probably the one you've all been waiting for, is investing into real estate. Real estate is by far the best way, in my opinion, to make money out of debt. You're essentially buying an asset worth hundreds of thousands of dollars with only a small amount of your own money down as a deposit. In some cases, this can be as low as 3.5% if you take out an FHA loan in the United States. Let's look at an example. Suppose you buy a $300,000 house with 3.5% down payment. This means you only have to put down $10,500 of your own money, but you now own an asset worth $300,000. Now, if the house appreciates by 5% over the next year, you've made $15,000 in capital gains from an initial investment of only $10,500. That's more than double your money simply by living in your own home for 1 year. Now imagine if you had multiple properties, or maybe you renovated the property to increase its value even further. You can see how powerful using debt can be when investing into real estate. It's why so many investors consider it to be the best industry to put their money to work. There are a lot of other investment options out there that we haven't covered in this video. The main point here was to introduce you to the concept of making money through debt. If you've understood the concept well enough, you will now know that first, you need to assess your risk profile and risk appetite. Then you will need to learn about the market and investment options as much as possible. Only when you are confident enough, you should execute your investment strategy to make money from debt. What do you think? Would you take out debt to invest? Or maybe you'd rather use the cash you have without taking out any loans? Let us know in the comments section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.